The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box this morning. We're live from London, and as you can see, Steve is live from Italy on a beautiful coastline as the G7 leaders prepare to meet. Here are your headlines today. The Federal Reserve leaves interest rates on hold at a two-decade high, signalling just one rate cut this year. As Fed Chair Jerome Powell says the fight against inflation isn't over yet.
The economic outlook is uncertain. We do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
Cooling inflation gives a lift to equity markets, pushing the S&P 500 to record highs, while Apple briefly overtakes Microsoft as the world's most valuable company.
French President Emmanuel Macron defends his snap election decision, calling on moderate parties to unite as he looks to stave off the rise of the far right.
We cannot remain indifferent or deaf to the message that voters sent, and we must offer a democratic response. This response, to me, could not come in the form of a changing government or coalitions that were simply impossible in Parliament.
The EU threatens tariffs of up to 38% on Chinese EVs. That's as the bloc's trade commissioner tells CNBC it deserves a level playing field.
What we want to ensure with this investigation is a fair competition, that Chinese companies are not gaining competitive advantage through injurious subsidization.
And the US widens sanctions against Russia on the eve of a crucial G7 summit here in Italy, as leaders look to agree a plan to use interest from frozen Russian assets.
No doubt it was a big day for the Fed yesterday and for markets, now looking at the assumption that we're back at one rate cut potentially this year. So a couple of dots the market closely eyeing at the start of the year, certainly sliding off into the horizon. The Federal Reserve once again holding its benchmark rate steady in the target range of 5.25 to 5.5% as widely anticipated. But the market's attention was elsewhere in its latest rate forecasts and economic projections. The latest dot plot projections point to just a single rate cut by the end of the year, a significant dialing back from March's forecast when it had penciled in 3 rate cuts. But the Fed raised projections for 2025, now anticipating 4 rate cuts. Speaking to reporters following the FOMC decision, Chair Jerome Powell said the Fed had made substantial progress tamping down inflation, but pricing pressures remain too high to justify a rate cut.
Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
Next to the dot plot, the Fed also released its latest economic projections. It nudged up its forecast for PCE and core PCE by 20 basis points, each to 2.6 and 2.8% respectively, suggesting sticky inflation still. Now, the rate is not expected to hit the 2% target until 2026. Powell said he is still seeing risks in the economy that could force inflation higher again.
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
A slightly hawkish turn from the Fed coming as we got fairly dovish numbers on the CPI. As we got that print for May, let's just take a look at those numbers. It held flat on the month and increased 3.3% compared to a year ago, both slightly below expectations. That was thanks to falling energy prices and only a fractional rise in food costs. The core figure, that rose by 0.2% on the month and 3.4% on the year. That was also lower than expected, Arabile.
Yeah, well, so markets had to react to all of this then and really take it on and see exactly what is it that the sentiment is. Is the 3-to-1 cut now a surprise for the market, well, it didn't seem too much so, really, when one takes a look at this market picture. You had a strong session, in fact, in yesterday's trade overall. So the picture was still around seeing equity markets move a little bit higher. Yes, sessions came off their lows. In fact, so much so that the Dow Jones Industrial managed to dip into the red. But the rest of the market moved higher, again on the basis of tech stocks, managing to also gain quite significantly there too. Each of the S&P 500 and the Nasdaq actually hit all-time highs again, 0.8% higher for the S&P 500. The Nasdaq composite 1.5% to the good. Like I said, again, those tech stocks, so the likes of Apple, Microsoft, and even Nvidia, all managing to move higher. Broadcom up double digits in after-hours trading. On to the treasuries then. What has this meant? Well, it actually dipped down as much as 14 basis points then for the 10-year as it went down to 4.3. In fact, now 4.32. In fact, this number even hit 4.25 at some stage then yesterday, then just highlighting that the market still anticipates a drop off in those interest rates then. Maybe one is certainly priced in, as the Fed did, but you could even see two certainly still in play here. Onto your dollar crosses then. The dollar slightly weaker today. That's after yesterday's softer than expected inflation print, as we've just made note of course, flatlining on the month-on-month figure then in the headline print there. The yen does, however, remain a little bit squeezed, so you're seeing it at 157.12 for now then, as we see the Bank of Japan also kick off its interest rates decision then today. Overnight, the euro did gain 0.6% and even hit its 200-day moving average, punching above that mark, in fact, in overnight numbers. Sterling also rising around 0.5% tonight. 128 is where you saw that. 127.77 is where it is right now. It is a little bit of weakness on that front. Over the Asian market then as well, overall here, Asian equities rallying a little bit. Investors trying to find some modesty with regards to that cooling inflation print that you found then, particularly the Hang Seng. The rest of the market, however, losing out somewhat. The Shanghai Composite 1/3% down, 1/10% weaker for the Nikkei out of Japan. That Hang Seng index actually moving high on the back of EVs, interestingly enough. The Chinese EVs themselves managing to move higher at some stage then today. You even saw the likes of BYD still up over 6% as well. So yeah, even NEO and Li Auto, all those shares moving significantly higher. We'll touch on that a little bit later on, Karen.
Arabile, thank you. Fred Newman's joined us now, co-head of Global Research Asia at HSBC. Fred, the central banks that we've been watching closely, Canada, Europe, have all decided to take the leap in terms of cutting interest rates, not the Fed. Do you think we are going to see one by September? The markets ratcheted up those expectations, 61.5% likelihood of a 25 basis point rate reduction in September. What are the chances in your view?
Well, the Fed is tiptoeing. It's not rushing towards the exit. So maybe a cut in September. But I think it's also interesting that they've actually reduced a little bit the expectations for this year. They're still saying between the lines, we have sticky inflation. Now, the market is saying, wow, next year we get 4 shiny rate cuts. That's great. But to be honest, that's a long time away. Let's not get too carried away with what they tell us about 25. Focus more on the near term. And the near term Fed saying, well, one cut, but that's might be it for this year.
The Fed kept spelling out yesterday, it needs more confidence. It's not confident enough. We kept hearing that word. But in terms of what we're seeing elsewhere, insurance cuts have been something that the market's spoken about. The fact that we've got this high level of restriction, it's too tight perhaps for some of the growth profiles we're starting to see emerge now into 2024. Is the Fed at the risk, running the risk of being too backward looking if it's data dependent, missing the window to execute?
That might be certainly a risk. On the other hand, if you cut too early and inflation re-accelerates, the credibility of central bankers is really at stake here. Remember, they were asleep at the wheel when inflation surged a few years ago. So if you now cut prematurely and you get just a tiny re-acceleration of inflation later this year, I think that would really be damaging for the credibility of central bankers. So there's also that to worry about. I think the big challenge for the Fed actually is to determine what happens to fiscal policy. Because remember, that's one of the key drivers of inflation. And we don't really know what's going to happen with the elections. What's the next year's budget going to be? Congress is very much a gridlock. Are they going to deliver an expansionary budget or not? And I think that uncertainty around fiscal policy is also a big worry for the Fed.
I'm glad you mentioned world leaders because Steve's going to jump in. He's at the G7 at the moment.
Yeah, Fred, look, a lot of people on this side of the Atlantic, especially and globally, like to diss everything that Donald Trump says before even thinking what he said. And look, don't get me wrong, he says some crazy stuff as well. But the fact of the matter is, he's been stunningly critical of the Federal Reserve under Jay Powell, and indeed the way the Federal Reserve conducts its business. And actually, you mentioned the word credibility in the Fed. Let's look at the record of Jay Powell over recent years. Completely and utterly mistypified the nature of inflation, calling it transitory and then having to walk back aggressively on that. Having a Fed pivot in late 2023, which was proved to be completely wrong for the market, and the market priced in 150 basis points and is now having to row that back aggressively, has been trying to say, yes, we're going to be cutting all year, but now is actually saying maybe it's only just one as well. Is the credibility of the Federal Reserve actually shot to pieces because its record says it's getting it wrong on a regular basis?
Well, as an economist, I have to defend my central bankers a little bit here, so you're not going to get me to be too critical of the Fed. But you're right. It was an extremely challenging period for central bankers, not just in the U.S., by the way, I think globally. Very few have seen the surge in price pressures after the pandemic. And of course, they're tasked with targeting inflation at 2%, and we massively overshot this. So you're right. Judging by the standard of inflation targeting, there was something at miss here. And I think that actually means that there's a bias towards holding back with rate cuts, because if you cut prematurely, then of course you just raise the risk of missing the inflation target for longer. And monetary policy is about cementing credibility. It's about inflation expectations. And so I think you're right. From that perspective, you might argue that you actually have an inbred sort of conservative bias for central bankers. And that, of course, sets us up for another policy mistake, which is that we cut too late. But I have to defend them a little bit because the outlook is extremely uncertain. A lot of it depends on fiscal policy. And as we know, the political side in most economies is very, very, so we say, murky at the moment. So it's not clear that we have fantastic fiscal monetary cooperation in most economies at the moment. And that makes the job harder for central bankers.
Fred, I hear what you're saying, but they have more data points than anyone else on the planet as well. They should be doing perhaps a slightly better job of gauging this stuff. The only other thing I will say is you're an economist defending a non-economist, because as we all know, Jay Powell isn't a trained economist. The second point I wanted to raise with you is something you said in your second answer to Karen as well. And this was, we have uncertainty over the US fiscal budget as well. I don't think we do. I think we know regardless it's going to be horrible, whether we have a Biden administration post this election or whether we have a Trump administration. The US is running and writing checks. It just can't necessarily cash over the long term. Of course, being the global reserve currency of the world, it gets a little bit more largesse than other nations, dare I say it, such as Italy would get as well. But the fact of the matter is, regardless of who is running the budget in the United States, who's running the Treasury, we're going to have horrendous deficits for the foreseeable future, aren't we?
We are going to have very, very large deficits. Absolutely. There is a need for fiscal consolidation in the U.S. as elsewhere in many, many economies. But even a marginal reduction in the deficit over the coming year would be a drag on the U.S. economy. So when it comes to the cyclical outlook, it's the marginal change in the deficit that matters. Overall, we have a debt problem. It needs to be addressed. We need to have consolidation. But is it going to come next year? Is it going to come in 26? Still matters for inflation over the next 12 months. And that's, I think that nuance is still important. And the political process is very unpredictable at the moment. We have a gridlock Congress. We have a very polarized, political landscape. And is that going to deliver us a 1% reduction in deficit, a 2% reduction in deficit, no reduction in deficit? These nuances still matter, even if the overall picture is debt, and too much of it.
Yeah, Fred, with all of that said then, and despite all that debt, there's still a robust U.S. economy that we're speaking about, right? My wonder is whether you then need the same kind of low interest rates as you had before, pretty much, because that economy doesn't probably need it to still perform at the high rate as it has already over the last couple of years.
That's right. And to your point, we have still an equity market that's scratching at all-time highs. We have a real estate market that's actually on the residential side not doing badly. Not everything suggests that monetary policy is actually very, very tight. And that brings me to another point, which is that one of the key messages from the Fed was that long-term interest rate expectations are now higher. They keep nudging it up. And that suggests that the neutral interest rate is climbing. And that would suggest maybe policy isn't that tight after all. So again, maybe that suggests the rate cuts aren't coming as hard as fast as many would like.
So does that still mean, though, that 2% as an inflation target then is still right to have? You're going to have rates higher for, ostensibly by the looks of it, even longer ultimately, even if it's not as high as it is obviously now. But then that means that you're still going to keep on fighting inflation. I mean, that the old narrative of 442, which is 4% unemployment, 2% growth, and perhaps 2% inflation, does that still carry?
It still carries in terms of the official objective, but remember they changed it a few years ago to say we want average inflation of 2% over many, many years, and we don't know how many years they really mean. So there's a lot of flexibility in there. I think it's still the aspirational target. I don't see it changing because it's important for inflation expectations management, right? That matters when you talk about monetary policy. But they're not aiming to bring it down 2% over the next 12 months. They're not maybe bringing it down to the next 24 months. It's medium term.
Fred, there's been some debate as to whether the Fed should be channeling its Greenspan-like characteristics now instead of Volcker. I mean, Volcker has been sort of the role model that everybody's been channeling to stamp down on that inflation rate. But Bullard's been talking about a Greenspanian type approach that effectively one rate cut, waited out 5.5 months back in 1995 and waited it out in terms of delivering another rate cut. Is that what we're looking at this time? Should we see a change of focus for some of those Fed members?
We are, absolutely, because Volcker had to punch down inflation. We had a decade of soaring inflation, double digits, right? You needed to do something to shock the system. This time around, inflation expectations are elevated, but they're not kind of completely unanchored. So the better approach is to be marginal, data dependent, as the Fed says, tweak it here and there, and that's what we're looking at. And that's why sometimes the messaging is a little bit, not quite as clear as market would like, but that's because the Fed's saying, look, it's an uncertain world. We can't pre-commit ourselves. Let's do maybe 25 basis points and see where we are in September. And then we're going to move forward. And that's why I think this idea that next year the Fed's looking for 4 rate cuts is a little bit overdone. That's a long time away. Yeah. Let's not get carried away and focus on that too much.
Bring back the mystery in central banking like it used to be, some cliffhangers after every other meeting. Fred, thank you very much. Fred Newman with us, co-head of Global Research Asia, HSBC. Our colleague stateside will be discussing all the latest economic developments out of the US with Treasury Secretary Janet Yellen. Don't miss that interview at 13:30 CET. And for the full post-FOMC statement, speech and analysis, you can head online to cnbc.com.
Now, coming up on the show, French President Emmanuel Macron attempts to seize the initiative, defending his snap parliamentary election in a mammoth 90-minute press conference. Plus, we'll hear from the European Commission's EVP and trade chief, that's Valdis Dombrovskis, as the bloc hits Chinese EV makers with higher tariffs. And we'll speak exclusively with the Atos CEO, Paul Saleh, about these companies' restructuring plans after 2 straight days of heavy share selling. That's coming up at 8:45 CET.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
We are at a moment when our country faces many challenges, and we cannot let the extremes stall it. It's a show of confidence in our people, our democracy, the Republican spirit, our national common sense. Turning to our sovereign people was, in my opinion, the only Republican choice.
That was French President Emmanuel Macron defending his decision to call a snap election, which has sent ripples through the financial markets. In his address, Macron urged political rivals to help him fight what he described a, quote, extremist fever spreading through France. He also appealed to voters, saying he trusted them to see the difference between expressing anger and building a serious project. Charlotte is here with more. Charlotte, looking at that framing of the shot of Macron yesterday, very much like the first round of his presidential election. So this is Macron almost in campaign mode for some of his party members.
Certainly in campaign mode. And look, every time I was looking at my phone yesterday, there was some news and something happening, because obviously President Macron doing this 2-hour conference there, explaining why he was calling this this election, because big dismay even within his camp, apparently. A lot of people not understanding what is happening, why calling this election now, and the implication of that election, like putting his whole legacy on the table with this vote. And in fact, it could be for France, and we saw the market being very jittery, what this could mean, potentially having the far right come in power, and the implications for Europe as well. Apparently in Brussels, there's also a lot of discontent with calling this election. So here again, the president explaining why he called this election yesterday and calling for other parties to join forces against the far right.
If I thought that I'd done everything right, I wouldn't be standing here today. I wouldn't have called an election and everything would be perfect. So yes, I have a responsibility, in the sense that I probably failed to come up with a solution that was swift and radical enough to some of our fellow citizens' legitimate concerns. The social malaise in rural areas, this feeling of not being in control, the fears that exist of falling off the social ladder in some neighbourhoods, and the risk is to turn to the extremes.
And look, it's a president that has faced quite a few crises since he got into power in 2017. You had the Gilets jaunes, of course, then you had pandemic, the war in Ukraine, in cost of living crisis, but this could be the biggest one yet. So we have to wait and see. But certainly the latest poll that we published last night put the far right at 31% of vote intention. The second bloc is the left at 28%. So here again, as we were discussing the other day, the left announced a union that they would put together just one candidate per constituency. And if they get their act together, they had a lot of dissension and a lot of problems within that union in the last legislature. But if they get their act together, depending on who they would put forward as Prime Minister, they could do it. It's very early days. Of course, the Rassemblement National is riding on the success that they had in the European Parliament. Here it's a 2-round election, so there's a lot of calculation that come into play. But again, it's interesting to see this result from the left being so close to the far right. But there's a lot of uncertainty. Les Républicains, yesterday, a whole circus happening. The boss of Les Républicains called for an alliance with the Rassemblement National. Most of the barons of the party were against that. They actually went to physically get him out of his office. He locked himself in the office of Les Républicains, so he's not the leader of Les Républicains anymore. So it's just the political implosion that started with Macron coming in the political scene seems to be continuing now, and it's just extraordinary to just see it all unravel. Candidates need to be put in place this weekend. The campaign starts on Monday, and it's just an extraordinary show.
Charlotte, thank you very much. We'll talk more about this later in the show.
Yeah, we certainly will. Now, the UK's opposition Labour Party will set out its stall to voters at its manifesto launch today, with leader Keir Starmer expected to pledge his government will be, quote, pro-business and pro-worker, in a speech centred on growth as well as wealth creation. That's according to our sister channel Sky News, and comes after the broadcaster grilled Starmer and Prime Minister Rishi Sunak at a televised event. Now, Starmer set out Labour's position on tax.
I think that working people shouldn't pay more tax, and we will not raise their tax. What we need to do is get the economy going. There's a reason that taxes have gone up so much in recent years, and that's because the economy is flatlining. We have to address that problem. And tomorrow our manifesto is a plan for growth, a detailed plan of the first steps we will do in government to get our economy working so that living standards go up and we have the money we need for our public services.
So no tax rises of any kind in the next Parliament under Labour?
No tax rises for working people, and nothing in our manifesto requires tax rises over and above those that we have specifically set out.
No tax rises in the next Parliament?
No tax rises needed in the plans in our manifesto.
In the plans?
No tax rises for working people. That's income tax, national insurance,
so you're
and VAT.
not ruling out.
Meanwhile, Prime Minister Rishi Sunak was asked about his own party's economic record.
When I got this job, inflation was at 11%. And I think everyone knows the last few years have been difficult, the impact that was having on all your bills. Every week you were seeing the impact in your shop, and that's why my priority was to bring down inflation, so to ease that burden. And it wasn't a given, and it was 11%. Now it's back to normal, ahead of our competitors, which is the result of a lot of hard work.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.